Hello investors, it's been another good month for your portfolio and our markets have touched lifetime highs. They're defying the global trend, and this is the question I ask myself every morning, that how long are we going to defy global markets? How can we be one of those solitary markets that is just and total outlier? And logically, the thought comes that it's good that global markets do get into the act sooner than later. If global markets do not push up, we could have problems moving ahead and sustaining these lifetime highs. So let me share with you a few observations I've had in the last few weeks. There have been some very good positive developments on the global front. So what I am going to share with you on your screen, you see, is something called the All Country World Index. We've shared that earlier with you. This is the summation of 48 global markets, the major markets, 3,000 stocks. What you will see is a 3-year chart. On the left, you see a dip. This was the COVID dip in 2020. Then you see a rally from 2020 all the way till the end of 21, which is in the midsection. And then a fall on the right-hand side, which has been the last one bear market that has happened globally. What you will see is, first and foremost, is that this correction that happened till a few weeks ago really stopped where the COVID top was, which is around 78. You can see the black horizontal line. So very often earlier tops tend to become good supports. Markets find supports near important levels, and you will clearly see that global markets in this downturn have found support at a very, very important level, which was the high made during COVID. The second thing we noticed, and this is more recent, this has actually happened in the last 2 weeks, is that if you see the red downward sloping trend line, this really demarcates the correction. And what you notice is that markets have moved above that. So this very often signifies a change in trend. A change in a downtrend, when the red line is broken on the upside, signifies the possibility of a reversal of trend in global markets, which is again a positive. And third, in the lower panel, you will see some lines which has a green circle, which really signifies the markets in an overbought, oversold scenario. You will clearly see that this indicator is moving from the lower half towards the upper half and moving ahead. So we can also say that momentum is going from oversold, excessive bearishness, to positivism. So these real three things, bring out the fact that I do get a feeling that the global markets are in a stage of recovery. They are in a stage of repair. So in case global markets continue to show strength, this could be a very big trigger for our markets to build on the new highs that we've made. As I said earlier, that we cannot be a solitary market making new highs forever. We need the tailwinds, and the good part is that I am seeing these tailwinds build, and this will be further positive for Indian markets. Now, if we look at global markets, this is a table which has 21 of the major global markets, and on the extreme right is the column is the distance from lifetime highs. So clearly you will see India is the cherry on the cake, probably the market that is broken to new lifetime highs, and below that is of course distance. Right at the bottom, no surprise, you find Russia. Below that is China, and you know that these are countries that are going through almost 50% correction thanks to their internal politics and the mess that they are in. But the good part is that we find ourselves at the top. Now, what I find very interesting, and I want you to really pay close attention to, is 3 indexes which are all US based. In fact, this gives us to understand the quality of move or where leadership is going to emerge globally in this uptrend. First and foremost is at number 4 is the Dow Jones Industrial Average. So you'll clearly see that the Dow is only 6% from lifetime highs, which is very impressive considering the way global markets are poised. So clearly the industrial stocks in the US, the Dow Jones Industrial Average, it is the average of industrial stocks, that is your good brick and mortar companies. It's just about 6%. So the old economy, the traditional economy, is showing a lot more strength than is generally given credit for. The second thing I want you to notice is the S&P 500, which is at number 12. This is a broad-based 500 market, good top end large cap market breadth index, which is about 15%. And you will notice that the Nasdaq, which is actually the most popular, which what people are following, trying to catch bases, doing SIPs in, is down still 30%. So what you will see is that relative strength is there in industrials vis-a-vis tech, and this is a very big shift we foresee happening in the global markets. This is going to have an impact of India. As trend investors, this is really what we do. This is what we do with your portfolio. We try to identify trends that are panning out and how they are going to shape profitability going ahead for our investors. So let me take this further and go into sectors in the Indian context. So these are NSE sectors, again 22 popular sectors. The interesting part is at the top is the banking. So you'll realize that the banking stocks are actually leading this rally. And that is why you'll observe that in the last 2 months, we have increased our exposure to banks. We were underweight banks, and banks actually did nothing for 2 years. But 2 months ago, we added Federal Bank. A month ago, we bought Bank of Baroda. That's a new addition, and a research report will accompany this particular video. So you'll realize that how from being underweight, we've gone overweight in banking, and we feel that leadership is coming here. And that is beautifully getting represented or captured by us by going overweight in this sector. The second sector we find very interesting is infra. So infra again has been a sector which has been underperforming for a decade. Nobody was speaking of infra and capital goods. But you will realize that infra also is at lifetime highs. And this again we have captured. You will realize in the last few months we've added stocks like we've invested stocks like LG Equipment and very other kind of plays, Apar Industries. So we have actually got into the capital goods and infra space, and that is really what we do. We try to identify leadership trends and we try to get your portfolio or navigate it. You will find that another sector that is looking very interesting doing well is public sector undertakings. So that is how we have got into many months ago into HAL, which is an aviation play, which is a play on defense, and it's a public sector undertakings. So this is how we are really sort of gliding your portfolio towards leadership, and that is really what trend investing is about. At the bottom of the pyramid, you will find real estate, media, IT. Again, sectors you'll realize we are underweight, and we don't want to be there because they are lagging. So this really makes you understand that what is being our strategy, how we have been navigating. I know that we have a lot of catch up to do. The last year has been very, very difficult for trend investors or growth investors. The reason is that in the last year, we've had many chops and turns. When the year started, IT was the flavor. And then IT sold off globally 30, 40, 50%. Then metals emerged for a few months. Then metals tanked. Then energy emerged. Then energy tanked. Then autos emerged. So what has happened in the last 1 year? We have not been able to capture a sizable trend. The markets have not been trending, so to say, or no sector or theme is trending. All themes are just running 1 or 2 months. So in these choppy times, as a trend investor, it gets challenging for us because we are not churning your portfolio every week, every month. For that, you will almost have to be a trader. But we feel that as 22 ends, I think in 23 we will start seeing the emergence of long-term trends. My reason for that is that the biggest culprit has been the rising interest rates. Interest rates never really help growth stocks. They tend to be quick trades. Sectors that are beaten down do well for a short period of time and then they get sold out. But inflation, we think, or peak inflation is behind us, and you can already see the Fed statements being much more dovish. And we feel that a little more of a stable interest rate environment will be good for growth and trend. And that is why we feel that 2023 will be a much, much better year and a good year for us to catch up. As I said, 22 has been underperforming, but we've been working hard, and you can clearly see how we have been navigating your stocks. The moment the trend plays out, I feel that we can really catch up and do that very, very soon. With that, I leave you for the last time in this year. Happy New Year well in advance, and see you in 2023. Thank you.